Good afternoon and welcome to this special broadcast. We're looking at the South African Reserve Bank's Monetary Policy Committee interest rate decision once more. And with the repo rate at 5%, economic growth rather slack and inflation rather high, it's unlikely that we'll get any changes in the interest rate. We have with us today Gerard Lampin from Sanlam iTrade and Kevin Links from Stanlib. Gentlemen, let's start with you, Kevin. Is there any reason she should change interest rates?
No, I think at this stage she just simply keeps them on hold. Obviously, we are still worried about the growth environment. As you said, it's not particularly good, and there's some elements that are actually worsening, particularly the consumer, which has been the key part of the recovery for South Africa. But she's got the concern that the currency is under pressure. We've got a little bit of inflation pressure that's creeping into the system. We've got a big current account deficit. So it's a difficult juggling game. I think she's got the right interest rate.
The Governor started her speech. So with that, let's cross to the Reserve Bank.
And the first briefing of the MPC for 2013. And at the outset, let me remind you of the scheduled dates for the March meeting, because that falls on the weekend of the 21st of March, which is a public holiday. So this year it will fall on given that the Thursday is the 21st of March, the meeting will go from the Monday to the Wednesday, and therefore the press conference will be held. We'll hold it at noon on the Wednesday, the 20th. So just to remind you of that, it was in our original schedule, but just to remind you of that change for the next meeting. Since the previous meeting of the Monetary Policy Committee, there have been some important improvements in the global financial market sentiment, but economic growth prospects in a number of the major advanced economies or regions remain constrained. Downside risks to the outlook persist as the structural problems in many countries, and in the Eurozone in particular, are still unresolved. Monetary policy in most countries is likely to remain accommodative in the absence of clear evidence of a sustained recovery, particularly against the backdrop of a relatively benign global inflation environment. Despite a generally positive reaction to the ANC elective conference, ongoing labour conflict, the proposed scaling down of mining operations and the rating agency downgrades are symptomatic of the challenging domestic outlook. In the absence of coherent and consistent structural policy initiatives, domestic economic growth is expected to continue to be well below both what is possible and what is required to make significant inroads into unemployment. In contrast to the situation in most advanced economies, the risk to the inflation outlook remains on the upside, due in large part to continued exchange rate and wage cost pressures. The year-on-year inflation rate, as measured by the Consumer Price Index for all urban areas, was 5.7% in December 2012, up from 5.6% in November. The categories of food and non-alcoholic beverages, housing and utilities, and transport together accounted for 3.5 percentage points of the inflation outcome. Food price inflation moderated from 7.5% in November to 7%, mainly as a result of lower meat and grain price increases. Core inflation, as measured by the exclusion of food, petrol and electricity from CPI, which had been unchanged at 4.7% since September, increased to 4.9% in December, mainly as a result of increases in services price inflation and in line with the bank's forecast. Administered price increases increased by 8.8% and by 7.6% excluding petrol. Having reached a recent low of 4.2% in September 2012, year-on-year producer price inflation increased to 5.2% in both October and November. This reversal of the previous downward trend was mainly due to price increases in mining and quarrying, agricultural products and manufactured food. Agricultural prices increased at year-on-year rates of 6.3% and 5.9% in October and November respectively, while manufactured food prices increased at rates of 10.9% and 11.1% in these months respectively. The inflation forecast of the bank reflects a further deterioration in the inflation outlook for 2013 compared with the previous forecasts. The forecasts do not yet incorporate the new CPI weights and rebasing recently announced by Stats South Africa, but these changes will be incorporated formally into the bank's next forecast. The impact on the inflation trajectory is likely to be marginal. Having averaged 5.6% in 2012, inflation is now expected to average 5.8% in 2013 and 5.2% in 2014, compared with the previous forecasts of 5.5% and 5% for the respective years. Inflation is expected to peak at 6.1% in the third quarter of this year, and then to moderate gradually to 5.1% in the final 2 quarters of 2014. This deterioration is largely due to higher expected food price inflation, the lagged effects of the depreciation of the rand, and higher expected unit labor costs. The forecast of core inflation is more or less unchanged, indicating the continued absence of significant demand pressures. This measure is expected to peak at 5% in the first 2 quarters of 2013 and to average 4.9% and 4.5% in 2013 and 2014, respectively. Inflation expectations remain anchored at around the upper end of the inflation target range. According to the survey of inflation expectations conducted by the Bureau for Economic Research in the fourth quarter of 2012, inflation is expected to average 6.1% in 2013 and 6.2% in 2014. This represents a marginal increase of 0.1 percentage point for 2013 compared with the previous survey, while the forecast for 2014 is unchanged. Business executives are the most pessimistic about inflation, having raised expected inflation rates to 6.6% and 6.7% in 2013 and 2014, while trade union respondents reduced their forecast to 6.1% and 6.6% respectively for these years. The forecasts for financial analysts increased marginally, but remain within the target range for the forecast period. For the past 4 quarters, expectations for the next 5 years have remained unchanged at 6.2%. The global growth outlook remains challenging, notwithstanding improved sentiment in global financial markets following the interim deal related to the fiscal cliff in the United States. The fiscal issues have not been fully resolved, with decisions on expenditure cuts and the debt ceiling delayed until later this year. While the worst-case fiscal scenario has been avoided, the uncertain fiscal outlook is likely to contribute to continued sub-trend U.S. growth. On the positive side, there are continued signs of a recovery in the U.S. housing market and improved corporate profitability. Although sovereign debt risks in the Eurozone have subsided for now, and bond spreads on peripheral European debt have narrowed significantly, the region is likely to remain in recession for much of the year, as fiscal tightening and balance sheet repair by banks and households continue. The unemployment rate has now reached 11.8%, with youth unemployment at 24%. The outlook for Germany, the main growth driver in the region, has also deteriorated. Growth prospects in the UK remain relatively weak, while the outlook for Japan is uncertain despite the announcement of substantial fiscal and monetary policy stimuli. The outlook for emerging markets, particularly those in Asia, is more positive. The Chinese economy appears to have stabilized following concerns about a possible hard landing, and consensus forecasts suggest some growth acceleration in 2013 in both China and India. Growth in Africa is expected to be sustained at rates in excess of 5%, while Latin American growth is expected to be more restrained, but an improvement on 2012. The rand exchange rate continues to pose an upside risk to the inflation outlook. The exchange rate has been impacted by the widening deficit on the current account of the balance of payments during 2012 and changing global and domestic risk perceptions, particularly relating to the adverse developments in the South African labour market and the downgrades by the various rating agencies. Since the previous meeting of the MPC, the rand has been fairly volatile, having appreciated initially from 8 Rand 94 to the US dollar to 8 Rand 45 at the end of the year, but subsequently depreciated to current levels of around 9 Rand to the dollar. Since the beginning of the year, the rand has depreciated by 6.1% on a trade-weighted basis and by 6.6% against the US dollar. While the rand is expected to remain sensitive to domestic and global developments, and continued volatility can be expected, most analysts do not expect significant further sustained depreciation in the coming months. The depreciation of the rand is expected to help moderate the current account imbalance, although platinum export growth may be undermined to some extent by possible shaft closures. However, financing of the deficit may be more challenging despite relatively high domestic nominal bond yields, as sentiment towards South Africa has deteriorated, and non-residents already hold over 1/3 of the stock of outstanding government bonds. Non-resident net purchases of domestic bonds totaled 88.6 billion during 2012, due in part to South Africa's inclusion in the Citibank World Government Bond Index. However, the pace of inflows declined substantially in the final quarter of the year, when net purchases amounted to 10.6 billion. Since the beginning of 2013, net purchases of bonds by non-residents have amounted to 4.3 billion rand. While non-residents were net sellers of equities during 2012 to the value of 3.4 billion, they were net buyers to the value of 7.3 billion in November and December. Year to date, however, the negative trend regarding equities has continued, with net sales of 2.3 billion as growth prospects remain weak. Domestic economic growth remains fragile and below potential, following an annualized growth rate of 1.2% in the third quarter of 2012 and an estimated growth rate of around 2.5% for the year. A similar outcome is expected in 2013, with growth of 2.6% forecast, revised down from 2.9% in our previous forecast. A more favorable outcome of 3.8% is forecast for 2014, compared with 3.6% previously, driven in part by a more favorable global outlook. However, the risks to these forecasts are assessed to be on the downside, given uncertainties and instability in parts of the mining and agricultural sectors in particular. Constraints to growth are both external and internal. To achieve a higher internally generated growth rate would require a serious commitment to implementing a range of structural reforms and making the necessary trade-offs as outlined in the National Development Plan. The outlook for parts of the mining sector is bleak, following continued labour disputes and announcement of possible closures of shafts and mines, a consequence of increased cost pressures, weak global demand and prices. Although mining output increased on a month-to-month basis in November, on a 3-month to 3-month basis, a contraction of 10.4% was recorded. There are mixed signals pertaining to the outlook for the manufacturing sector. The real volume of manufacturing production increased by 2.3% in November, its highest month-on-month rate in 4 years, due in part to a rebound from widespread strike activity in previous months, and growth in the fourth quarter is estimated to have been relatively robust. Capacity utilization has also increased. However, the Kagiso PMI declined to below the 50 index point level to 47.4% in December, indicating an expectation of some contraction in the sector. The negative business sentiment evident in the confidence indicators is also reflected in the continued weakness in private sector gross fixed capital formation. Recent developments in the mining sector are likely to reinforce this weakness as plans are scaled back. Investment expenditure is likely to remain underpinned by the government and state-owned enterprises. In the third quarter of 2012, gross fixed capital formation grew at an annualized rate of 7.2%, but private sector capital formation, which accounts for just under 2/3 of the total, only grew at a rate of 2.8%. Growth in consumption expenditure by households moderated as expected in the third quarter of 2012, when it increased by 2.6%. The main driver of the moderation was the decline in expenditure growth on services and non-durable goods. However, there are also signs of moderation in the growth of expenditure on durable and semi-durable goods, and the depreciated exchange rate is likely to sustain this trend. Growth in motor vehicle sales has slowed in recent months, and there was a marked decline in the confidence of new vehicle traders reported by the BER. Despite the higher-than-expected increase in retail trade sales in November, the quarterly rates suggested further moderation in growth. The FNB BER Consumer Confidence Index declined by 2 index points to -3 index points in the final quarter of 2012. On balance, the MPC does not assess growth in household consumption expenditure to be excessive or to pose significant inflationary risks, and further moderation is still possible. Factors that affect the outlook for consumption expenditure, both positively and negatively, include concerns regarding employment, wage settlements, credit extension, particularly unsecured lending, and administered price increases, which impact on discretionary spending. The upward momentum of banks' total loans and advances to the private sector has continued, with 12-month growth of 9.9% recorded in November, the highest growth rate since February 2009. Excluding mortgage advances, which remain subdued, the increase in November was 18.3%. Bank credit extension to the household sector increased by 10.4%. General loans to households, which is mainly unsecured lending, while still exhibiting rates of growth in excess of 30%, show some signs of moderation amid reports that banks are becoming more cautious in extending new loans in this category. Access to new loans may also be constrained by the increased size of outstanding debt. However, despite rising debt levels, household debt to disposable income appears to have stabilized at around 76%. The MPC remains concerned about the potential impact of the higher level of wage settlements on employment and inflation. There are indications that wage increases are trending higher, with growth in nominal remuneration per worker increasing from 7.2% in the second quarter of 2012 to 8.1% in the third quarter. Once productivity increases are accounted for, this translates into unit labour cost increases of 6.1% and 6.7% in these respective quarters. According to Andrew Levy employment publications, the overall wage settlement rate in collective bargaining agreements amounted to 7.4% in the first 9 months of 2012. The MPC is mindful of the danger of a possible wage price spiral and further employment losses should unaffordable real wage demands be granted while economic growth remains constrained. The risks to inflation, should this scenario play itself out, are significant in the absence of productivity gains. The subdued pace of employment creation in the private sector has been further undermined by the fractious nature of recent wage negotiations and the announcement of further possible restructuring in the mining sector, which would involve the closure or mothballing of mines or shafts. According to the quarterly employment statistics survey of Statistics South Africa, non-agricultural formal sector employment grew by 1%, or 82,000 employees, in the year to September 2012. Almost two-thirds of this increase was accounted for by the public sector, while net job losses over this period were experienced in the manufacturing and construction sectors, with employment in the mining sector unchanged. However, in the third quarter of 2012, 15,000 jobs were shed in the mining sector, and there are fears that this trend could continue. Employment in the agricultural sector, which is not covered by the survey, is also at risk. Food prices continue to pose a significant near-term risk to the inflation outlook, although there are signs that these price pressures may moderate during the year as a result of favourable base effects, as well as the recent moderation in global and domestic wheat and maize prices. The price of these commodities will also be influenced by developments in the exchange rate of the rand and unpredictable weather patterns. Administered prices remain on average well in excess of the upper end of the target range, and there is as yet no clarity on the new Eskom tariffs to be implemented later this year. At this stage, a 16% tariff increase is assumed in the forecast. International oil prices have remained relatively stable for the past few months and are more or less unchanged from the previous meeting of the MPC. Futures prices reflect an expectation of some moderation in coming months, but some volatility can be expected. The domestic price of petrol, which is also impacted by the exchange rate, declined by a cumulative 34 cents per litre since early November, but much of this decline is likely to be reversed in February. The MPC continues to assess the balance of risks to the inflation outlook to be on the upside. While the risks to the forecast emanating from food prices may have diminished somewhat, particularly over the medium term, the average rate and wage settlements remain the key upside risk factors. The exchange rate and wage settlements remain the key upside risk factors. While the reweighting and rebasing of the CPI is still to be finalized, the impact is likely to be marginal, but on the upside. Core inflation trends indicate that demand pressures are relatively contained and household consumption expenditure has continued to moderate. Risks to economic growth are assessed to be on the downside, particularly given the uncertain outlook for the mining industry and the ongoing unsettled labour relations. The negative output gap is therefore expected to persist. The MPC remains concerned about the possibility of a wage price spiral and its potential to exacerbate the high level of unemployment in the economy. As we noted in the previous MPC statement, concerted action is needed on the part of all the parties involved. We need cohesion of policy and decision-making to provide the necessary certainty for sustainable economic growth and development. The monetary policy stance remains accommodative and appropriate, with the real policy rate remaining slightly negative, notwithstanding the expected temporary breach of the inflation target. However, further accommodation at this stage is constrained by the upside risks to the inflation outlook. The MPC has therefore decided to keep the repo rate unchanged at 5% per annum. As always, the MPC will monitor developments closely and will not hesitate to act in a manner consistent with its mandate. Thank you.
Good afternoon, Governor. It's Renee Volgra from Sunday Times. Governor, I have two questions. Firstly, the inflation forecasts of the bank that you just gave to us, does that include the marginal upside impact of the CPI re-rating and rebasing?
No. We're saying these are the forecasts. That has not yet been finalized. They will be finalized and should be in the next forecast, but not in this one. So there will be slight upside to these numbers.
And secondly, Governor, I want to know, how big is the concern in the MPC about the Rand's movement over the last month?
Okay. Let me briefly deal with the second question briefly. Obviously, we're concerned in the sense that if you looked at it, the Rand has been volatile. It moved into what was, for a relatively stable period, into sort of 8 Rand 20, 8 Rand 50. It then moved to about 860, 880, 890. This is a fairly sudden move and quite big. It has breached the 9 Rand to the dollar. So we're concerned about the volatility in particular, but also the level. And the question is, of course, how long it stays there and what its impact is. So you can see already it has retraced a little bit, but we would watch it quite carefully. It is a concern both for, obviously, in terms of inflation, it's a concern. In terms of volatility, giving the certainty that investors need or in exporters would require, it's also a concern. Obviously, a weakened exchange rate does help in terms of competitiveness, but you want the less volatility with that level. So it is a concern for us. Miriam, did you have a hand up?
Well, actually, Renee has asked the question I was going to ask, but I have another one. We haven't yet had the final determination of Eskom's electricity price proposals. Would this add upward pressure to the inflation outlook if it did come through at 16%?
Well, as we said, it's already factored into our forecast at 16%. So no, not if it is at that level. But we need to wait and see what the outcome is before we're able to make a pronouncement on what its impact would be. Obviously, as you've all seen and reported on, the hearings are taking place, and there is an expression of concern of the impact of this level of increase on an annual basis for so many years. So we'll see what the outcome is, but 16% is what has been forecast in our assumptions. Let's first see if there's someone else. Anyone else?
Okay, was there any discussion of a rate cut at the meeting?
Actually, no. I think this was, as I've said before, we are quite frank about it. It is a robust discussion. The decision was unanimous. There was no equivocation and no discussion either of a rise or of a cut. It was, from these numbers, our view was that we hold where we are. Yolanda?
Governor, a question via the webcast from Robert Price. Would a hike in interest rates not encourage savings, capital accumulation, and investment, the drivers of long-term economic growth? Thank you.
Who would like to take that one? Rashad?
Yeah, I guess this is a PhD thesis, but there have been times in the South African economy where real interest rates and nominal interest rates were very high, and savings rates were not as high as we expected. So I think this relationship between interest rates and savings, is determined by a number of things. For example, there is an argument that one of the reasons why the savings rate is low in South Africa has to do with massive unemployment, the nature of distribution in the country. So it is true that interest rates has an effect on savers and borrowers, and it is true that an increase in the interest rate can encourage savings. But by and large, the problem of low savings in this economy is determined by a much more serious problem around the nature of credit and a number of things. So, in the scheme of things, it's not wrong to say a slight increase in interest rate will encourage savings, but South Africa's savings culture has to change fundamentally. It will depend on something more than the interest rate.
Yes, sir.
Well, there we have it. The decision, it's not a non-decision, as the Governor always stresses. It is a decision, but the decision was not to move. We'll get some insight from our esteemed economists in a moment, but first it's time for an ad break.